All right, picture this for a second. You've got a company that is quite literally burning through $5 billion a year. But somehow it is gearing up for the absolute largest IPO in human history. We are talking about a proposed $1.75 trillion valuation for SpaceX. Now, here's the hook that's going to keep you glued to this explainer. The most shocking part of this whole financial setup isn't the rockets or the satellites. It's that the biggest buyer of this record-breaking stock is actually going to be you. Welcome to the explainer. Today, we're unpacking the exact arguments and data from our sources to see how the modern financial system is engineered to use your retirement account without your explicit permission. Let's get right into it. So, to really wrap our heads around the sheer scale of what we're looking at, $1.75 trillion. To put that into perspective, at that valuation, SpaceX would be worth more than literally every single American defense contractor combined. Honestly, scratch that. Let's go even bigger. It would eclipse the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks all put together. That kind of mind-bending valuation doesn't just demand a good business, it demands absolute, untouchable perfection and market dominance. But this massive, astronomical valuation brings up a really glaring paradox. I mean, if a company is targeting an IPO of nearly $2 trillion, you'd probably expect it to be this absolute fortress of profitability, right? Well, here's the reality check our sources highlighted. SpaceX is currently operating at a massive $5 billion net loss per year. So the obvious question we have to ask is, who in their right mind is buying a company that's bleeding $5 billion a year at the single highest valuation in history? And here comes the killer punchline to that exact question. Brace yourself, because the answer is you. Or, to be a little more specific, your retirement account. The core argument we're looking at today is that within just a few weeks of this potential listing going live, your 401k, or your favorite passive index fund, is going to automatically become one of the biggest buyers of SpaceX stock. And the craziest part? It's going to happen whether you explicitly want it to or not. To understand how that's even mechanically possible, we really need to look under the hood at what SpaceX actually is as a business. Okay, let's dive into Section 1, inside the SpaceX valuation. To make any sense of that $1.75 trillion number, we have to kind of shatter the illusion that SpaceX is just a rocket company. It's actually more like three totally distinct businesses stacked on top of each other. And this breakdown brilliantly illustrates the part of the company that's considered the biggest drag on value right now, XAI. So XAI is the artificial intelligence lab Elon Musk founded in 2023, and SpaceX recently scooped it up in an all-stock deal that valued XAI at a whopping $250 billion. But look at this discrepancy. Our sources point out that OpenAI generates an estimated $24 billion annually and is valued around $850 billion. Anthropic pulls in over $30 billion and sits at a $400 billion valuation. XAI? Well, they're estimating just $1 billion in revenue, yet somehow command a $250 billion price tag. On top of that, XAI is burning through more than $1 billion a month. Oh, and by March of this year, all 11 of its original heavyweight co-founders had actually walked out, leaving the whole operation to be completely rebuilt from the ground up. Now, what's really fascinating is how this frames the part of the business that everyone actually knows about, right? The rockets. We're talking about launching satellites, sending cargo up to the ISS, running critical NASA missions. While that sounds incredibly futuristic and cool, the financial reality is that the famous rocket business only generated roughly $4 billion last year. That is just about a quarter of SpaceX's total revenue. Don't get me wrong, it's a solid business, but it is definitely not enough to justify a multi-trillion-dollar valuation. The real financial engine of this whole operation lies somewhere else entirely. Which brings us to Section 2, the crown jewel, Starlink. So this is what the analysis describes as Comcast, but in space. And the sheer scale of Starlink is just genuinely staggering. Right now, there are over 10,000 Starlink satellites floating in Earth's orbit. 10,000! And they are beaming high-speed internet down to over 10 million active subscribers, spread out across roughly 150 different countries. Plus, it's not just consumer internet anymore. We're talking maritime operations, commercial aviation, and even highly classified defense contracts. Starlink alone pulled in roughly 61% of the company's total revenue. Our sources point out it is currently the fastest-scaling telecom company in human history. But honestly, the top-line revenue isn't even the most impressive part here. What's truly awe-inspiring, according to the analysis, is Starlink's accelerating efficiency. Look at this. Just 2 years ago, Starlink's profit margins were sitting at about 41%. Fast forward to this year, and they have absolutely ballooned to 63%. That's over 20 points in margin expansion in a remarkably short amount of time. Between Starlink and the rocket business, these two core segments are highly profitable, they're printing cash, and they're doing incredibly well. So wait a minute, this brings us to a huge, absolutely crucial point. If Starlink and the rocket business are so incredibly profitable, why did we start this explainer by saying the overall company loses $5 billion a year? Well, the answer is that XAI basically dragged the entire consolidated company down. While the core space and internet businesses brought in roughly $8 billion in profits, the massive cash burn happening over at XAI resulted in the consolidated SpaceX entity posting a nearly $5 billion loss on about $18.5 billion in total revenue last year. Let's move on to Section 3, changing the Nasdaq rules. Which brings us right back to our original burning question. How on earth do you take a company with a consolidated $5 billion loss public at the highest valuation in human history? Well, the real story here isn't about magic satellites or cool rockets at all. It is entirely about the hidden mechanics of the financial system. Specifically, the analysis claims that the Nasdaq is quietly changing its rules right before this massive IPO hits. To really grasp why this matters, we have to look at the immense, undeniable power of the Nasdaq 100 index. It is the absolute gold standard for technology companies. But it's not just a fancy club. There are over 200 investment products out there holding over $600 billion in assets that literally just track this index. Meaning, if a company gets included in the Nasdaq 100, it forces every single one of those passive funds to automatically buy the stock. Period. It is guaranteed manufactured demand that translates into billions of dollars of blind investment capital. Now, under the old rules, a newly listed company had to wait at least 3 months to be added to this index. And that wait was absolutely crucial for what we call price discovery. Basically, giving the free market time to figure out what the company is actually worth before forcing all these passive funds to buy it. However, there is a brand new policy that was adopted on May 1st called the Fast Entry rule. This new rule takes that standard 3-month waiting period and compresses it down into a mere 15 trading days. They are taking 3 months of essential market testing and squeezing it into just 3 weeks. Then, right on day 16, the automatic ETF buying kicks in. And it gets wilder, because the fast entry rule is just one piece of this puzzle. The source identifies 3 specific rule changes that look exactly like a red carpet being rolled out, tailored specifically for SpaceX. First, you've got the fast entry rule we just talked about. Second, the complete removal of the 10% minimum free float requirement. See, previously, a company needed at least 10% of its shares available to the public just to join the index. SpaceX is reportedly targeting a tiny free float of just 4 to 5%. So under the old rules, they literally wouldn't even qualify. Under the new rules, they're good to go. And third, they added this highly technical thing called a hidden multiplier. Okay, let's break down that hidden multiplier because it's a bit complex but absolutely vital. Buried deep in the technical language, the new rules dictate that for companies with a free float under 20%, the Nasdaq will now treat that float as if it were 3 times larger than it actually is. Let that sink in for a second. That means SpaceX's actual 4 to 5% float gets weighted by passive ETFs as if it were 12 to 15%. This rule change essentially forces index funds to buy significantly more of the stock than the actual public availability would normally dictate. It's artificially manufacturing immense demand out of thin air. And these rules aren't just a one-off for SpaceX. They perfectly pave the way for similar companies like OpenAI and Anthropic to list under these exact same engineered conditions. This brings us to Section 4, exit liquidity. And this is where we get to the final and frankly the most critical reveal of this explainer. With the runway perfectly cleared and demand artificially manufactured by these new rules, who is actually on the other side of this massive transaction? Normally, most IPOs allocate maybe 5 to 10% of their offering to everyday retail investors. But SpaceX, they are reportedly targeting an unprecedented 30% retail allocation. Which brings us to a really stark warning highlighted by portfolio manager George Noble in our source material. He said, and I quote, "Your 401k is the exit liquidity." Think about what that actually means. The buyers and sellers here are not showing up at the same time. This structure practically ensures that early insiders who got their shares for pennies on the dollar are able to unlock and sell their bags at a peak newly engineered valuation. Meanwhile, passive funds and retail retirement accounts are effectively forced by these new rules to step in and absorb all those shares. Ultimately, this analysis pulls back the curtain on the unseen mechanics of passive investing. For years, passive investing has been sold to the public as this massive triumph of common sense, right? Low fees, broad diversification, a super easy set it and forget it strategy. But there is a much darker side to that exact pitch. The very mechanism that makes passive index funds so incredibly convenient is the exact same mechanism that makes you a guaranteed automatic buyer for anyone who manages to squeeze their way into the index. And it doesn't matter if that company is fundamentally profitable, and it certainly happens without anyone ever asking for your explicit consent. Which leaves us with this final, truly provocative question to ponder from today's explainer. What is the real, hidden cost of your passive index fund? If the foundational rules of the financial system can literally be engineered to generate guaranteed demand for an unprofitable company at a record-breaking valuation, how much control do you actually have over your own retirement money? It's a complex, wild intersection of space ambition and Wall Street mechanics. Thank you so much for joining us on this explainer as we walked through this incredibly detailed analysis. Keep asking those hard questions and always look closely at the hidden mechanics of the financial world. Catch you next time.